When people look at commercial real estate, one of the first questions they ask is simple. Will this property actually make money? The answer depends on understanding how return on investment, or ROI, is calculated and what factors affect long-term performance. ROI in commercial real estate measures how much income or profit a property may generate compared to the total invested. Investors should look beyond purchase price because expenses, financing, repairs, taxes, insurance, vacancy, and maintenance all affect returns. A property may look attractive on paper, but the real question is how the numbers perform after expenses are considered. Net operating income, or NOI, is the income from the property minus operating expenses like maintenance, insurance, management, and taxes. NOI usually does not include for financing costs or loan payments. So it shows how the property itself performs before financing. Cap rate, or capitalization rate, helps compare a property's income to its value in a simple percentage. Higher cap rates may suggest higher potential returns, but can also indicate more risk depending on property and location. Lower cap rates are often associated with more stable or highly desirable markets and lower perceived risk. Cap rate is one of the most common ways investors compare commercial properties quickly. Cash-on-cash return measures the return based on the actual cash invested after financing is considered. If you use a loan instead of paying all cash, cash-on-cash return shows how hard your invested dollars are working. Cash-on-cash return is especially important for investors using financing because it focuses on the money they personally put into the deal. Even a property with strong numbers can become risky if vacancy is high or tenants are unstable. Long-term tenants, reliable businesses, and favorable lease terms improve investment stability. Location, nearby development, traffic patterns, and local business activity all influence occupancy and demand. A fully occupied property with strong tenants may produce more stable long-term performance than a property with higher returns but frequent turnover. Sarasota continues to see growth in business activity, population, healthcare, tourism, and professional services, which can influence demand. Different property types perform differently. Industrial and warehouse can benefit from logistics demand, while retail and office depend on location and tenant mix. Not all commercial properties perform the same way. Market demand, location, and property type all play a major role in ROI potential. Some properties look profitable up front, but unexpected expenses like taxes, insurance, maintenance, and build-outs can affect long-term returns. Consider property taxes, insurance, maintenance, roof or HVAC replacement, parking repairs, build-out costs, management, vacancy, HOA, or CAM fees, utilities, and legal and closing costs. Some properties look profitable up front, but unexpected expenses can significantly affect long-term returns. Due diligence matters. Review leases, tenant history, property conditions, zoning, environmental concerns, inspections, and local plans. Inspections, environmental reports, lease audits, and understanding local development plans reduce risk and reveal hidden issues before you buy. Working with a local commercial real estate advisor helps you interpret numbers, spot market quirks in Sarasota, and negotiate better terms. At DAG Realtors, we combine local Sarasota market knowledge with commercial experience to help investors evaluate ROI and manage risk. If you want help assessing a specific property, call or visit DAG Realtors and we can walk through the numbers with you. Understanding ROI, NOI, cap rate, cash on cash, vacancy, hidden costs, and local trends gives you the confidence to make smarter commercial real estate decisions. Start with careful analysis, run the numbers, and lean on local expertise to increase your chances of a successful commercial investment in Sarasota.